Okay, folks, so we need to give a violent update on the market and plays, including some big trades that are running quite a bit. And then for the main entree this lovely evening, I want to talk about what the hell just happened with Ooga Booga AMC as well as GME. A lot of folks are peeved after this morning a halt came in and stopped one of the most concentrated rallies they've seen in months. What's going on? Will the momentum come back? And what is my take? Okay, let's go ahead and start with an update on the Marketa. Another super fun day. Markets are still eerily friendly right now. You got another 1% push upward in the broader market, officially breaking past the double top here from early February. You trace back to the first time we declared these levels. We were around November 1st of 2021. We're starting very, very quickly to retrace areas that weren't established that long ago. But we're also in time periods where the macro conditions and the macro threats were a lot different. But for whatever reason, this guy has taken over and bulldozed over the bears. If you mess with the bull, you better be ready to deal with the horns. If you're a tech or a growth tech investor, you probably saw your portfolio outperform the broader market by about 3 or 4 times in the last 2 or 3 weeks. You look at one of the more aggressive growth tech funds out there, Cathie Wood's Poor Arc, she's up 36% since just March 14th. Triple Q, which tracks the NASDAQ, up 16.66% in that same time period, and the S&P up 10.68%. A lot of folks like to shite on growth tech and tech stocks in general because they're so volatile, and they go down so damn much when people are fearful in the market. But when you get into a situation where things are stable and things are healthy and people are willing to invest in the future again and look out more than just a couple months, all of a sudden they go up so fast that your head spins off. I'm not convinced at all that this risk-on period is going to last. But just remember how fast these things can go up when they do turn around and when they actually do have a rally that sustains itself. Okay, moving on. In terms of the catalyst section of today's morning briefings, these were the 5 from today. I do want to highlight a few because I think there's a lot that folks can learn from this. The first one is IGMS. We briefed on it because it was a small biotech company up after a big pact with a much bigger company, Sanofi. If you watch our videos a lot, you know that one of the things we look for in hype trades is small, unknown, tiny market cap companies doing some sort of partnership or affiliation with big, well-known companies in their space, especially if it's in healthcare or biotech. That's what made this one run, and we briefed on it in the 20s about 30 minutes prior to market open as usual, and it ran to 35. Of course, we also have standards. We believe in standards here at ZipTrader. My minimum requirement for a bull setup was for it to hold its support at 1975, and especially win and hold breakout of resistance at 2086. It did both. It satisfied the criteria and it went on to run very, very nicely. The other one that I want to highlight is CLVR. This one is a perfect example of why standards are so important. Yesterday, CLVR got obliterated on the overall MJ cool-off. This morning I woke up and it was attempting a comeback. The push downward yesterday, in my view, was far too aggressive given the potential catalyst that is later this week and given how good they did on earnings that they reported last week. I felt that they actually deserved some of their earnings run, not all of it, but some of it. And so when you actually did get a little bit more risk on trading back into MJ, you would see this run. And I thought that would happen today, which is why we briefed on it. I set standards for holding support at 195 at the bare minimum. What happens? Well, it ends up falling from 218 to literally 2 cents over our support level to 197. It holds that criteria and it breaks out and hits 328, a run from 197 to 328. Talk about getting very, very close to that support level. But in this case, it did what it needed to do and it bounced off it, and it was lovely. SXTC is a stock that did really, really well this morning, but is also a very good example of why you can't hold garbage can stocks when they're no longer satisfying your entry and exit criteria. This was up a lot and showing proof of concept and technical indications of a bigger breakout in the pre-market when we briefed on it. The minimum criteria for a bull run was holding or retaking support at 28 cents. It held that almost exactly. And then it ran up to just under 50 cents. And by 7:25 a.m. Charlie, California time, it was crossing the no-go zone into negative price strength below our SMA line, and it tapped out. Minimum standards, clear entry and exit plan are a bare bones, minimal effort sort of thing that you need to do if you're going to speculate and play a lot of these catalyst plays. What about GFA? This one was rallying on expanding its footprint in Dubai and Australia. It's been a bit of a momentum beast the last few weeks, and it probably will have more momentum rallies over the next couple of weeks on a rolling scale. What happened with it today? Well, it broke below my bull standards. Couldn't hold support at 158. It tried later on, once again failed. So the point is you're going to get tons of catalysts and tons of different market conditions. Some market conditions are going to make all your catalysts run, and some market conditions are going to beat them all down like rabid dogs. Woof woof. If you don't have standards and clear entry and exit plans, you're going to be just throwing darts at a board. Imagine not having standards in your dating life. Oh, I'll go out with anybody that breathes, and then you're confused when your significant other that you just found goes out, dresses like a lobster, and fights crime on the beaches at night. Hey, you're asking for it. Have some damn standards. And by the way, if you're into that kind of thing, no judgment. In terms of HYMC though, just to conclude this short-term catalyst trade segment, we did get another breakout into a new 180-day high, breaking both previous resistance levels. The run this morning predated AMC's big run by a few hours, and then when AMC got halted, HYMC just really tanked. I say, hey, you got a good breakout. There's going to be more opportunities in the future. Let it breathe. Be stoic about it. You can always trade new momentum rallies if they appear. Okay, moving on. We are going to be talking about Ooga Booga AMC and GME in just a few moments. But first, a word from our sponsor. During this period of out-of-control prices and shaky equities, you may be wondering how you can both invest and protect your capital effectively. And let's face it, it's never a bad idea to diversify into real assets. We've spoken about this before, but one of the oldest real assets is more accessible than ever before. It's part of a $1.7 trillion asset class and is largely uncorrelated with other real assets. I'm talking about art. Not just any kind of art though, but the legendary stuff that you see at auctions. Picasso's, Banksy's, Basquiat's. Instead of having to bring millions of dollars, appraisal skills, and good taste to an auction, Masterworks now allows you to buy fractional shares of their hand-selected art pieces in a way that's quick and convenient. And let me tell you, they are picky. Despite being one of the largest buyers in the art market, less than 2.4% of works pass their due diligence process. This is probably why they've been able to select huge winners, like their Banksy Mona Lisa, their George Condo piece, and their Albert Alhelm piece, with each earning a return over 30% IRR. Legally, I have to add, this is not an indication of Masterworks' overall performance, and past performance is definitely not an indicator of future results. But it's that diligence and revolutionary approach that has attracted them 360K plus registered users and a net annualized track record of 15.8%. I encourage you to hit the link below, learn about a variety of different offers and historical returns, and see if something interests you. At the very least, you learn something new. At the very most, maybe you diversify your portfolio. Back to the content. So the momentum has been building and snowballing in meme revenge stocks, and that is cultivated in one of the most concentrated breakout attempts that we've seen in like 6 months, and it was quite beautiful. You had AMC, which already more than doubled in the last few weeks and was up 45% yesterday, take an aggressive jump from $28 to $30 towards market open today, and then right at market open, it jumped from 30 to 34 in the span of like 5 minutes. Based on how much buying pressure appeared in such a short amount of time and how selling pressure could not be found to meet said buying pressure, you were already in a period where you were having very huge fulfillment issues and prices were skyrocketing exponentially. But you were only in the early stages of that. If that was allowed to continue, it probably would have got to 37, 38, then 40, then 45, and maybe even 50 and beyond. You gave this another 10 minutes, you probably would have been at 50 easily. Of course, though, it did end up getting halted. Once it reopened, aggressive sellers flooded the market, and all of a sudden, all these shares were available, and it dumped massively, dramatically killing that wave of momentum that we saw that morning. Wouldn't want it to go up too fast, right? Dangerous. GME, very similar situation, also rocketed into open, then got hit right after the halt. Now, obviously, I'm sure that retail traders were very thankful for the halt today. People were just having too much fun over too short a time period. AMC and GME surging is just as much of a risk to short sellers as it is to retail traders who hold it. Studies show that you can actually die from excitement. Excitement can trigger heart attacks, cardiac arrest, strokes, and other potentially fatal medical emergencies. Your body reacts to excitement in much the same way it reacts to feelings of fear or stress, by releasing hormones called adrenaline and noradrenaline. However, and this is the big catch here, too much adrenaline and noradrenaline can be dangerous to the heart, brains, and other organs. An enormous shock, whether positive or negative, can cause your heart to speed up, beat irregularly, or stop. And in patients with pre-existing heart disease, the fight or flight response can dislodge arterial plaques, sending blood clots to the heart, causing a heart attack, or to the brain, causing a stroke. So are you hearing this? AMC and GME rallying too much could literally cause your heart to stop beating. It could dislodge your arterial plaques. So I mean, when you think about it that way, halts aren't just about promoting market stability, but also about protecting public safety and public health. But of course, we as greedy, pathetic, and non-appreciative retail traders who try to steal from the big money weren't really appreciative of this. Ortex tweeted that they generated Type 2 and Type 3 short squeeze signals today before the halt, and they're registering short interest at 21% of free float. A lot of people felt that this would have been the biggest rally that we've seen since like June. Twitter user Donahue George said, quote, "The hedges halted trading of AMC and GME. Is the SEC going to allow this to happen again? Will the dog step in? They steal from us every day, and when we start to win, they change the rules, shut the system down. SEC, DOJ, any comments?" Now, to be clear, just make sure that you understand that halts are done by the exchanges, and it happens when criteria is hit for a circuit breaker to be triggered. But of course, while it wasn't the hedge funds or short sellers that halted this, a lot of people do feel in a sense that it was, because guess what? A lot of the rules seem to benefit the hedge funds when push comes to shove. And of course, there's a revolving door between hedge funds and regulators and folks on the exchange anyways. Another user said, quote, "GME and AMC were criminally halted within the first 5 minutes of trading after gaining more than 10% due to the limit up, limit down rule. This didn't stop Wall Street coordinated short attacks, dropping both approximately $8 to $10 in 5 minutes. Now, obviously the best time for short sellers to sell something short and dump tons of shares on the market is during and after a halt. If you have all your orders ready to go when things start trading again, all of a sudden you get into an environment where everything's going down and the buyers can't catch up, especially if those buyers are retail based. A halt on a rising stock is trying to do what? Well, stop the rise. So if you're a short seller, that's go time. Circuit breakers are an important part of the market to keep markets operating in a somewhat efficient and stable way, stable in quotations. But there's no denying that as a side effect, institutional traders get a huge edge over retail. If you write a rule and your intention is not to screw retail traders, but that rule still does screw retail traders, it doesn't have to be a conspiracy to say, hey, well, the rules are kind of stacking the odds against us. You know that I love to work with analogies, and the analogy that I make with this is that it's sort of like you have two armies, a captor army and a rebel army. The captor army has a ton more resources, strategy, might, training, and the rebel army only has hope, heart, and a little bit of weapons that they've managed to scrap up. Now, if the captor army and the rebel army were to go head to head, the captor army would obliterate the rebel army. But war is not just about might, it's also about logistics. If the rebel army goes and attacks the captor army off guard, it could cause significant casualties before the rest of the captor army and the rest of the captor's resources can actually go and meaningfully defend them. Basically what happened the last few weeks, the captor army was caught off guard. It did not expect massive double and tripling of these big meme revenge stocks. Short sellers had no idea you'd see a storming of rebel soldiers on the borders of these stocks. And so they took massive casualties. Just yesterday, AMC was up 45%. That's significant ground in just a day. Rebels stormed and they took a ton of territory. And this morning they tried that same tactic and they were killing it. But all of a sudden you had a war referee come in and say, hey, wait, everybody stop the war. Let's stop for about 5 minutes, take a breather, and let the captor army use their logistics systems to bring all the troops needed to that front. And then all of a sudden we're supposed to be surprised when they take back ground. The captor army was given enough time to prepare and then throw a massive strong defense that got a skyrocketing stock to dump from 34 to 26 in the span of 30 minutes. Before that, you couldn't even find shares to buy. All of a sudden, you get that 5-minute break and there's tons of shares available. They're everywhere. You want AMC shares? You want AMC shares? AMC shares for everybody. Welcome to Oprah. Now, at the end of the day, let me be clear again. It wasn't the hedge funds or the short sellers that halted these stocks. Obviously not. It's halted on the exchanges with clear circuit breaker rules. But if you look at this analogy, you could see how the rules kind of screwed retail traders today. And by the way, I wasn't going to go there because this is on a speculation basis, but let's just go there. If you're a fund that works as a market maker or in any way, shape, or form helps fulfill retail trades, and you see a ton of buying pressure on something that you may or may not be short on, or one of your affiliates may or may not be short on, well, guess what? You also know the circuit breaker rules. Who's to say you're not a trickster and you decide to group all of your buy orders all at once and then reject all your sell orders at once, causing the circuit breaker to be triggered a lot faster and then benefiting your short positions, controlling the overall uptrend before it gets too carried away. Again, speculation, just my opinion. Personally, I think that everybody in the market operates fairly and justly, and they just want to do the right thing. I don't believe in this whole greed thing. The only greed I see is from retail traders that want to make money on their positions. sickening. But anyways, folks, look, at the end of the day, these stocks have gone up rapidly. With a new round of momentum and attention, you get a new round of potential outbreaks. And we've seen that hit again and again over the last 2 weeks. As these attempt upward, I think you're going to see a lot of defensive measures to make sure that you see some range controlling. And one of the things that I thought is if you see this holding in the 30s, you're in this area where a lot of short sellers are deep in the red, and you're also in an area where a lot of FOMO buyers are like, it's holding the 30s pretty well. Looks like it's primed for a breakout. I think short sellers don't want this above 30. I think that short sellers are pissed that this is above even $1. But above 30, they're like, oh no, this is not good. This is not good. This is like a whole nother battle here, and we'll see who wins this. Inevitably, you're going to get days where you're going to get a massive cool-off. But again, look at where this retains value on those cool-off days. We haven't had one yet since the massive outbreak, so we have to really be looking for that. Cool-offs can be a reversal, or they could be a break in an overall massive uptrend. And which it will be hasn't been decided yet, so keep that in mind. Anyways, folks, that caps off this video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. If you'd like to learn how to trade with our step-by-step lessons, our private chat, our daily morning briefings, and our full-price target list, I'll put a link to ZipTrader below. Coupon code NEVERGIVEUP, because we never give up market conditions that are good or market conditions that are bad. Thank you, Masterworks, for sponsoring today's video. Learn more about investing in art with our link down below. Have a good one, and I'll see you in the next video.